Joby Aviation Inc. is currently trading at 11.24 USD, marking a significant intraday decline of 15.93% as of this moment on Thursday, January 29, 2026. This sharp drop has sent shockwaves through the electric vertical takeoff and landing sector, leaving many investors wondering if the floor is finally falling out or if this is simply the cost of doing business in a capital-intensive industry. While most of the market was watching big tech names like NVIDIA stock or checking their performance on the Fidelity mobile app, Joby was quietly preparing a massive financial maneuver that has now come to light, catching the retail crowd off guard. The immediate expectation from the general public was that Joby, having secured a lead in FAA certification stages, would glide smoothly toward its 2026 commercial launch in Dubai. The reality, however, is a harsh reminder that building an aerospace company from scratch requires a nearly bottomless pit of cash, and today's price action is the direct result of the company going back to the well for an upsized $1.2 billion capital raise. This massive influx of capital is a double-edged sword that many users of Robinhood stock trading or the SoFi trading platform are currently grappling with. On one hand, the $600 million in common stock and another $600 million in convertible senior notes gives Joby the oxygen it needs to reach the finish line of type certification. On the other hand, the pricing of that common stock at 11.35 USD represents a massive discount to yesterday's closing price, and the sheer volume of new shares being issued is creating a dilution event that is hard for even the most optimistic bulls to ignore. If you are practicing self-investing through an individual brokerage, you have likely seen this pattern before with early-stage tech, where the gap between expectation and reality is filled with the cold, hard necessity of liquidity. When we look at the actual movement today, the trading volume has spiked to levels rarely seen for Joby outside of major regulatory announcements. Institutional activity suggests a massive reshuffling is occurring. While long-term holders like Toyota Motor Corp and Delta Airlines have shown commitment in the past, the current volatility is attracting a different kind of player. Those who use interactive brokers trading or sophisticated Fidelity wealth management tools are likely looking at the Delta offering, a complex mechanism involving over 5 million borrowed shares to facilitate hedging. This isn't just a simple sell-off, it is a structured financial event that is resetting the valuation of the entire eVTOL sector. If you are managing your own retirement through Fidelity IRAs or using the SoFi robo-advisor, the noise today might feel overwhelming, but it's essential to look at why the company felt the need to upsize this raise from $1 billion to $1.2 billion. The answer lies in the aggressive manufacturing targets Joby has set for 2027. They aren't just looking to fly a few taxis in Dubai. They are trying to scale production to 4 aircraft per month across their California and Ohio facilities. This requires massive upfront investment in tooling, staffing, and specialized aerospace components. For those who track online investing trends or frequent investing sites for advice, the narrative for Joby has always been about being first to market. However, being first is incredibly expensive. We are seeing a similar tension in the broader market with companies like Tesla stock, where the cost of scaling new technology often leads to periods of extreme share price suppression. Investors who are used to the steady climb of Apple stock might find the 15% daily swings of Joby to be stomach-turning, but this is the reality of the hardware-heavy transportation business. If you are looking for investment help to navigate this, it is worth noting that Joby still maintains one of the strongest balance sheets in the space, even before this new cash injection. At the end of the last quarter, they had nearly $1 billion in liquid assets. This new $1.2 billion raise effectively doubles their runway, ensuring they won't have to worry about bankruptcy before their aircraft are cleared for commercial flight. This creates a fascinating situation for those using the Robinhood app or SoFi Invest. The market is punishing the stock for dilution, yet the fundamental risk of the company running out of cash has been almost entirely eliminated. It is a classic case where the short-term technicals are at odds with the long-term structural health of the business. Comment below how many shares of Joby Aviation you currently hold, or if you are waiting for the price to stabilize before entering a position. Let's step back and look at what Joby Aviation actually does to understand why this capital is so critical. They are developing an all-electric 5-seat aircraft that can take off vertically like a helicopter but fly forward like a traditional airplane using 6 tilting rotors. The goal is to provide a quiet, zero-emission alternative to urban congestion, moving passengers at speeds up to 200 miles per hour. Unlike some competitors that use an asset-light model, Joby is vertically integrated. They design the parts, build the planes, and plan to operate the actual taxi service themselves. This is why their capital needs are so much higher than a company simply selling parts. They are building a service, an app, a charging infrastructure, and a fleet all at once. For those who prefer online investment in companies with full control over their ecosystem, Joby is the ultimate play in this sector, but it comes with the weight of massive operational overhead. The regulatory environment is where the tension between expectation and reality really heats up. Throughout 2025, Joby made steady progress through the FAA's 5-stage certification process. They are currently deep into the 4th stage, which involves detailed testing and data collection. The expectation among the retail crowd, especially those using Robinhood fractional shares or SoFi active investing, was that certification was a foregone conclusion. The reality is that the FAA is notoriously meticulous. Every software update and every bolt on the airframe must be validated. Joby has been performing for-credit testing, meaning the data they collect now actually counts toward their final approval. However, any minor setback in these tests can delay the launch by months, and in the world of high-burn startups, months are measured in hundreds of millions of dollars. Comparing Joby to its peers gives us more context. Archer Aviation has taken a slightly different path, partnering heavily with established aerospace firms to speed up their timeline. While Archer is also a popular pick on investing sites and for those who self-invest, Joby's go-it-alone strategy has allowed them to retain more of the future value, assuming they can successfully cross the finish line. We've seen other companies in this space, like Lilium, struggle significantly with the same capital requirements that Joby just addressed. By securing $1.2 billion today, Joby has arguably moved into a different league than its smaller competitors, even if the stock price doesn't reflect that strength right now. For someone looking at interactive brokers' fees or comparing Fidelity brokerage options, the decision to hold Joby is a bet on the survivor of a very expensive war of attrition. Looking toward the future, the catalysts are clearly defined but high stakes. The commercial launch in Dubai is scheduled for later this year. This will be the first time the world sees these aircraft operating in a real-world high-traffic environment. If successful, it will provide the proof of concept that investors have been waiting for since the company went public via SPAC. On the domestic front, the partnership with Delta Airlines to provide home-to-airport shuttles in New York and Los Angeles remains the crown jewel of their business plan. These are high-margin, predictable routes that could turn Joby into a recurring revenue powerhouse. But again, the reality must meet the expectation. The vertiports need to be built, the pilots need to be trained, and the public needs to feel safe getting into a pilot plus 4-passenger electric pod. For the active trader using the Robinhood cash management features or the Fidelity trading platform, the next few months will be about watching the settlement of this stock offering. Usually, after a big raise like this, the stock finds a new baseline as the new shares are absorbed by the market. We might see Joby trade in a tight range around the $11 to $12 mark while the market digests the dilution. The risks remain centered on the FAA timeline and the burn rate. If Joby spends this $1.2 billion faster than expected, or if the Dubai launch hits a regulatory snag, the market's patience will wear thin. Conversely, if they hit their 2026 milestones, today's 15% drop might look like a gift in the rearview mirror for those who understand the value of a well-capitalized leader in a new industry. In summary, the movement we are seeing today in Joby Aviation is a classic market overreaction to a necessary corporate action. The expectation was a smooth path to commercialization, but the reality is that the path is paved with expensive infrastructure and the need for a massive cash cushion. By raising $1.2 billion, Joby has diluted its current shareholders, but it has also arguably saved the company's future by ensuring it can survive the final, most expensive stages of flight testing and manufacturing ramp-up. For investors who are used to the volatility of early-stage tech or who have watched the growing pains of other major industrial shifts, this is a familiar story. The gap between what we want the stock to do and what the company must do to survive is where the most insightful investment decisions are made. Whether you are managing an intelligent portfolio or using a Fidelity Wealth Management advisor, the core question is whether you believe in the viability of electric flight. If the answer is yes, then the long-term potential remains, even if the short-term chart looks a bit bruised. The contrast between the excitement for a flying car future and the gritty reality of aerospace financing is what defines Joby right now. As the dust settles on this capital raise, the focus will shift back to the skies, where Joby must finally prove that it can turn its years of engineering into a profitable, scalable business.